Hi, everyone. I'm Kieran O'Dwyer, Vice President of Corporate Communications at Mutual of America Financial Group. Thank you for joining today's Economic and Market Perspective webinar. Today's focus is why inflation continues to impact the financial markets, economy, and consumer. During the first half of 2022, four key issues continue to drive a historically turbulent period for both stock and bond investors. Inflation's upward trajectory, the U.S. Federal Reserve's continuing to tighten monetary policy, the ongoing war between Russia and the Ukraine, and the lingering impact of the global pandemic. Now, as we enter the second half of the year, the view ahead remains murky as inflation takes center stage and volatility and uncertainty continue to reign. To provide insights on reasons behind these issues and how they may influence market movements and the economy in the months ahead, please welcome Stephen Rich, Chairman and CEO of Mutual of America Capital Management, LLC. Thanks for joining us again, Stephen.
Good afternoon, Kieran. How are you doing?
Very good. Very good. Looking forward to unpacking a lot here over the next half hour on the economy and the markets. Now, I know inflation is on just about everyone's mind these days, but I'd like to take a first look at the financial markets, which really struggled broadly across all sectors in the first half, especially during the second quarter. Can you take us through some of the key factors that affected market performance in the first half, starting with the equity market?
Yeah, of course, Kieran. The markets have experienced a lot of volatility, both on the equity side and on the fixed income side. And as you suggested in your opening comments, there's sort of four things going on here that create uncertainty. That's inflation at a 40-year high. You have the Fed, who's beginning to tighten monetary policy to tame inflation. You've got the ongoing war with Russia and the Ukraine, and you've got lingering impacts of the global pandemic. So all four of these things continue to create volatility. As you can see in the first half, markets were down, equity markets across the board. If we go back to the previous slide, I'd just like to highlight a couple points here. One is that the more growthy oriented those indices are, such as NASDAQ and the Russell 1000 growth, those were down the most, versus value, which was down not quite as much, but also in negative territory with the Russell 1000 value down 12.9%. In fact, the differential between growth and value in the first half was over 15 percentage points that value outperformed growth. And a lot of that has to do with interest rates. And as interest rates go higher, it creates a discount rate that is higher, which then when discounted back makes growth companies a little bit less valuable than value companies. So that's one of the underlying trends between growth and value. If we move to the next slide, we can take a broader look at the first half of the year and put it in a longer term context going back to 1960. As you can see, 2022 was the worst first half since 1970, when the markets were down 21% versus 20% for the S&P in this particular calendar year. You can also see that there are only 3 incidents where markets were down more than 20% in the first quarter, or excuse me, in the first half, one being this year, once again, one being in 1970, and then the other one being in 1962. And you can also see from this chart that there are only 7 occurrences since 1960 that the S&P was down more than 10% in the first half. So we're really in unprecedented waters in terms of equity market returns and sort of the pain that's been felt through the first half of the year.
Even as equities steeply declined into bear market territory, bonds have hardly been a safe haven as inflation continues to move through the financial system. What's happening here on this next slide that I want to share with you?
Yeah, you can see from this chart that returns in the fixed income market are almost as severe as the equity markets, which is something that's uncharacteristic. And it's really a result of the inflation and the tightening that the Fed has embarked on in terms of trying to tame inflation. As you can see, these bond returns are negative in the double digit. The 10-year Treasury down 11.3, 30-year Treasury down 22.9. You look at the corporate bond index, it's down 14.4, and even the aggregate's down 10.4%. These are pretty big moves in the bond market. In fact, we haven't seen back-to-back years where bonds have had negative returns since going back to 1956 and 1957. So it's been a long period that we've seen 2 years in a row, sort of back to back. And it is, once again, a function of rising interest rates. And, this should be taken into context that we've been in a bull market in the bond market since the 1980s, as rates have continually fallen. And now we've started to reverse that course as rates are rising.
So clearly, as you mentioned just there a minute ago, with equities down, bonds down, in the first half, inflation took center stage, in the first half of this year. And it continues to push forward due to factors such as increases in global commodity costs, consumer demand, wage pressures, and supply chain bottlenecks, among other major issues. As the chart shows here, I just wanted to share with you some key government indicators highlighting this troubling data. Can you shed a little bit more light on what's happening here, both with the core personal consumption expenditures and then also the more recognized CPI, Consumer Price Index?
Yes, as we look at all these gauges, and these are the three most common gauges that we find in certainly the press, the core personal consumption expenditure number at 4.7. This is the gauge that the Fed tends to focus the most on. And as you alluded to, the Consumer Price Index at 9.1, this is a number that seems to be highlighted more often in the press. Just speaking to the core PCE, this is at an elevated level. All three of these levels, really, the Fed is targeting a 2% or below. So you can see that they're all elevated. But in terms of the personal consumption expenditures, I'd like to put that in context into the 1970s. And we go back to Federal Reserve Chairman Paul Volcker, when he took the core PC from 10% down to 4%, or a lowering of 6 percentage points over that period. So if we take the May reading of 4.7 and a target of 2%, that's a change of approximately 300 or 3 percentage points. And so just putting it in context, that's about half as much work that needs to be done in the current environment that we felt in the 70s. So perhaps that's somewhat of a positive in terms of the work that the Fed needs to do in order to tame inflation. Turning to the CPI, this number has continued to rise. This is the highest level since we've seen since November of 1981, and it also represents the 16th consecutive month that it's over the Fed's target of 2%. So that's well over a year. And I think it's pretty clear at this point that the Fed believes that inflation is not transitory at this point, and they certainly made that pivot earlier in the year. And I think this chart really shows sort of the consistency of the upward trajectory of the CPI, really beginning in 2021 going forward. And this is an area that we'll continue to highlight. We do believe that over the course of this year, this should start to moderate. Whether or not it gets close or how close it gets to the 2% target is really something that all markets will continue to monitor, and will really be the measuring stick whether or not the Fed is being aggressive enough in terms of slowing the economy and slowing demand, which creates this inflationary environment.
That is quite a move, as you indicated there on that chart, how the interest rate or the rates have gone up to over 9%, and steadily each month. Is there relief in sight there?
I do believe that we are getting to what one would call peak inflation. And so I think as we move through the back half of the year, these numbers start to get statistically a little bit better. However, one of the real wild cards here in terms of hurting this CPI number is the price of gasoline, which we'll cover a little bit later. But this is a direct input into this, as well as a housing or rent equivalent number that's used in the CPI data. But we do believe that over the course of this year, this should start to moderate. Whether or not it gets close or how close it gets to the 2% target, I think that's really an outstanding question at this point.
Thanks. You do bring up a great point about some of the elements that are factoring into inflation, oil being one of them, and the prices of commodities such as oil at the start of 2022 were already elevated. And yet the war in Ukraine, as we all know, continues to exacerbate the problem, with crude oil pushing past $100 per barrel for the first time since 2013, as we can see here in the chart. Take us through the global issue impacting oil prices right now.
In my opinion, oil represents and is the most known and watched global commodity in the world. It's something that's measured and sort of watched on a daily basis. And we have seen an uptick in the price of oil. And as recent as the middle of June, it actually was over $120 a barrel. Since then, it has come down slightly. But there are a couple reasons why oil has been particularly strong. And one is, as you've outlined, the supplies are constrained by the Russian and Ukraine war that's going on. That certainly limits global supply, or at least disrupts global supply to a large extent. And then the other point I would make is that, at least in the US, we've really underinvested in the energy sector, and in particular in infrastructure, whether that be pipelines. And as a result, there's been reduced drilling in the United States. So there's less supply relative to where we were in previous periods. And why is this important? Well, oil is a feedstock to many products, including gasoline. And the other interesting part about this inflationary commodity is that this is an area where the Fed really does not have particularly a lot of control. Raising interest rates doesn't do anything on either the supply or the demand side of the energy market. In June, however, President Biden did release oil from the Strategic Petroleum Reserve at a million barrels a day. This has had a limited effect on the price of oil, even in the face of that. And a lot of that has just really to do with the infrastructure or the lack of infrastructure that we have in place. Refineries are running at capacity, so even if there's more oil available, it's not able to be transformed into products like gasoline or jet fuel.
From a U.S. consumer standpoint, it boils down to gas that people really see what's hitting them most at the pump, and has impacted their purchasing power. And much of the attention, as we know, has been focused on gas prices and food. Just looking at this chart, what's happening at the gas pump, and where might the average price go? We've seen a little bit of a relief recently, but it is the summer months, and prices tend to be high.
Yes, there is a tight correlation between gasoline and oil, or I should say oil and gasoline. So as oil goes higher, as a result, gasoline also per gallon increases. And you can see from the beginning of the year through June 11th, gas prices have gone up about 41%, which is a pretty big number. And I think this hits people squarely in their pocket. Uh, in mid-June, the price of oil, or excuse me, the price of gasoline on a national basis was $5.11. That coincided with that move in oil up to and over $120 a barrel. Subsequently, the price has come down. I believe that in some states they've taken down the taxes that have been collected, which helps in terms of that price. But you've also seen a slight dip in the underlying commodity of oil. Today, the underlying commodity is at or about $100 a barrel. And I believe as of this morning, the price per gallon of gasoline was at $4.50. So this is certainly going in the right direction. However, this is still very, very high relative to where we were even going back to March 30th of 2020 at $2.10. So this continues to be a real drag on the consumer. And like I said, this is one area that the Federal Reserve has less control about reducing the impact of the prices.
Thanks. $2.10 sounds like such a long time ago. Another area affecting Americans on a daily basis, as I mentioned earlier, is clearly food. Give us a sense of what's happening and taking shape domestically with the price of food, and whether prices may or may not go back down to what consumers were used to seeing.
Yes, Karen, food prices are another sore spot for the consumer. As you can see, for all these basic products here on a 12-month price change, these are all very strong. Cereals up 13%, meat and poultry up 11.7, dairy products up 13.5, fruits and vegetables 8.1, non-alcoholic beverages 11.9, and other home food at home up at 14.4%. So as you can see, on average, these food prices are all increasing at about a 1% per month clip, and that's pretty hefty. And if you look over the last 20 years, the all food category, food has on average been up 2.4% per year. And so, as you can see, all of these numbers are significantly above what we've seen in the past. Once again, I think this is both a supply and demand issue. On the supply issue, things like the war in Russia and the Ukraine, or I should say in the Ukraine, have created global shortages of certain certain products such as wheat and corn. But on the demand side, what we continue to see is that the consumer has a very strong balance sheet. With almost $2 trillion in savings, there's still ample demand for these products. And at this point, I believe that consumers are willing to continue to pay these prices rather than adjust their way of life and defer and go to other products. So I think there's both really a supply and demand issue that's going on at the moment in terms of the cost of food prices.
The chart on the CPI with all the select food categories quite instructive, and it does show what's happening, as you mentioned, to the prices. But even before these products end up in the supermarket or on families' tables, as commodities, a lot of these prices have been elevated, depending on non-agriculture and agricultural commodities, as we see in the next chart. Most of those were significantly elevated from a commodity standpoint. But there's been something of a split since. Take us through what's happening here and how consumers are impacted by the non-agriculture and agricultural commodities.
Right. So you can see from this chart, we've got four commodities that are down year over year, and we've got four commodities that are up. And I would divide these into two categories. The top four being non-ag. These are commodities that are used in industrial use, how I would determine it. And then in the bottom, these are more ag or agriculture, and these are more consumer products. And just going back to the previous discussion on the previous page, at least on the bottom, corn, wheat, sugar, and cotton, these continue to be consumer-driven demand products where the consumer continues to purchase and continues to keep these prices elevated. What we've seen on the non-ag products is, I think, a pullback from industries. And we've started to see that industries are starting to slow some of their purchases of inventory. And these particular products are really part of that inventory surplus that companies buy. And we've started to see these roll over year, which I think is actually a good sign. And it shows that some of the inflationary pressures, at least globally, are starting to ease. And this should make it easier for companies as we go forward to obtain and purchase these particular commodities.
Thanks, Stephen. With all this in mind, with commodities and food and gas and so forth, and the commodity-driven inflation spike, and the fact that inflation has not been declining, at least in the numbers we're seeing, the Federal Reserve, I just want to touch on that now. We haven't talked about them yet, and they've really shifted, arguably, some say too late, from an accommodative monetary posture earlier in the year to a much more aggressive approach, and triggering a series of interest rate hikes designed to slow down the economy and reduce inflation. What are some of the factors that might help to prevent the economy from sliding into a recession?
You're correct, Kieran. The Fed has really embarked on a mission to tame inflation. And they are now embarked on their most aggressive monetary policy in over 3 decades. They've switched from a accommodative monetary posture to one which is particularly hawkish, or another way of saying it, aggressive in terms of what they're doing. Thus far, they've raised rate 3 times, a 25 basis point raise, a 50 basis point raise, a 75 basis point raise, and it's expected that in July they'll do another 75 basis points, bringing Fed funds rate at the bottom end to 2.25. If we look at where expectations are for where the Fed would end the year, and this is coming from what's called the Fed dots. So these are actual estimates from Federal Reserve personnel around the country. They believe that Fed funds should be at 3.66 by the end of the year, which would indicate that there's some more aggressive raising of interest rates that we're going to see as we move through the balance of the year. As you suggested, the Fed is trying to engineer a soft landing and avoid a recession. A soft landing is when the Fed begins its cycle of raising rates like they are currently, but they don't tip the economy into a recession. So even currently, I think there's a debate among investors and economists whether or not we are in a recession, and how long may that recession last. Just one data point: of the 11 recessions since 1954, there were only 3 successful soft landings, one in 1966, 1984, and 1996. So the record of soft landings is somewhat mixed and would skew more towards ending up in a recession than not, just given historical numbers.
Great, thank you. And I want to come back to the Fed in a minute, but also thinking about interest rates, we look at that the consumer is going to notice is the housing market, which has been until recently red hot. Consumers are getting squeezed by high home prices, but a shortage of housing in the U.S. has kept demand and prices high. Now mortgage rates are rising to levels not seen in years. Uh, That said, this feels a little different than the housing crisis back in 2007, 2008, 2009 during the recession then.
Yeah, I think you're right about that, that it does feel like a different market environment. As you can see from this chart, mortgage rates for a fixed year mortgage have begun to rise in the beginning of July, standing at 5.3. If we go back to the beginning of the year or the end of year at 12/31/21, the rates were 3.1. So this has been a large increase in terms of mortgage rates. However, I believe that the housing market is on much firmer ground than it was certainly back in 2008 and 2009 during the great financial recession, where purchasing homes was more on a speculative basis. In today's environment, there's actually a structural shortage of houses in the market, which keep prices and demand pretty well in check. I think the other thing to consider is that over the last 2 years, home appreciation across the country is up almost 40%. So while I could see, giving up some of that strength that we've seen over the last 2 years, I really feel like the market is on pretty firm grounds from a housing perspective, which is another reason why, this helps the consumer. The consumer has a lot of equity in their home at this point because of the buoyancy of the market. And I think that helps us to avoid a recession and people missing payments on their houses, et cetera.
Right. Another area of the economy that we touched on is that continues to show strength is the unemployment rate or jobs. The most recent Bureau of Labor Statistics survey showed that healthy numbers of jobs continue to be reported, and it's been an overall a tight labor market. How will this affect the Fed as it tries to cool the economy?
This actually gives the Fed quite a bit of breathing room in terms of their ability to raise rates and cool the economy. They're starting in a very good point with unemployment levels at almost historic lows at 3.6. The long-term 50-year low is 3.5. So we're basically at that point. And we've got a very tight job market. There's about 5.9 million people who are unemployed, and there are actually almost twice as many jobs at 11.3 that there are job openings. And so there's a nice, I'll call it, imbalance between the amount of supply and demand, which should keep unemployment rates particularly low, and gives the Fed the opportunity, I think, to increase rates a little bit more aggressively, rather than if unemployment rates were higher. That being said, I think one thing to put in perspective is that in every recession, and that's in the 11 that have been measured since back into the 60s, unemployment has increased in every one of those by as little as 1.9% in 1960 and as much as 11% in 2020, which we all remember quite well. But the point being is that it's likely that unemployment will move higher. How much higher, once again, is something we will need to continue to monitor. But in the current state, this is a favorable backdrop for the Fed and their tightening cycle.
No doubt they have their work cut out for them. I don't have a chart for the next question. I just want to get some brief feedback from you on the growth of the business sector. 2021, as we know, was one of the most profitable years for American companies in decades. This year, obviously, those profits look at best to run maybe at single-digit levels. Even with such uncertainty in the economy, is it fair to say those double-digit numbers were not sustainable? And what are we looking at now moving forward this year?
Yes, 2021 was one of the best years on record for corporate profitability. And it's anticipated that there would be a slowing of growth in 2022. And economists are also looking for slowing growth in 2023 as well. And so the way I kind of capture this or think about it is companies really over earned in this period. And so now this is a period where they're going to return more to normal type of earnings. And as a result, there will be some slowing. While they'll still be growing, they'll be growing at less fast pace. And I think I put this in the context of a recession. And we know that the first quarter GDP was a negative number. It's estimated that the second quarter GDP number may also come in as a negative reading. So I think there is good data out there suggesting that we may already be in somewhat of a recession. It may be very shallow, and I would term it as a company or earnings recession at this point. We are not in a consumer recession like we were in 2008 and 2009. And so I think that's how I kind of square this stuff together, in that the company side, the industrial side is starting to slow, but the consumer hasn't started to slow. And so I would classify this as a mild type recession at this point, and hopefully something that we will be able to grow out of towards the back half of this year and into 2023.
Thanks, Stephen. And I know while inflation is top of mind with everyone, to your point, the R word recession is generally not far behind, and that's something I appreciate your thoughts on that as we look ahead to the rest of 2022 and what that might look like from a recession standpoint. And just finally, we've covered a lot of ground here today. I appreciate it. While the financial markets declined at a historic rate during the first half of 2022, just kind of maybe summarize some of the issues, both the positive and the negative, that are worth keeping an eye on as we move deeper into the second half of this year.
Yes, Karen, these are some of the issues that we've talked upon. On the positive side, job growth remains strong. Near-term record low unemployment rates. This gives the Fed a lot of breathing room in terms of their ability to raise rates. Corporate balance sheets are very strong. Consumer balance sheets are very strong as well. Healthy consumer spending from excess savings throughout the pandemic. And interest rates are still relatively low. And I think that's even reflected in the mortgage industry. And these are still rates that are not stopping people from purchasing homes. On the negative side, inflation seems to be pretty stubborn, and it's not backing off as quickly as the Fed would like to. They will continue to be very hawkish as we go through the balance of this year. Consumer prices for gas and food remain high, which weakens consumers' purchasing power and will erode that savings that they've put away as we move through the balance of this year into next. And the Fed continues to be aggressive in terms of their rate hikes, which will most likely push yields higher, which will have an effect on both potentially the equity markets and the fixed income markets.
Thank you, Stephen, for all your insights today. We really appreciate you taking time to share all your insights with us, and we look forward to our next discussion in October.
Thank you, Karen. It was a great conversation we had, and I'm looking forward to our October meeting as well.
Great, thank you. And so this concludes today's webinar. As I mentioned, our next quarterly economic and market perspective with Stephen is expected to take place in October. I will send you an invitation in advance and hope you'll join us again at that time. Before you leave, we'd appreciate if you'd take 1 minute to complete a brief survey about today's presentation and to let us know about topics and issues you might like to hear about more in the future. Finally, today's webinar will be available soon to watch at mutualofamerica.com. You'll also be able to visit the webinar section of our online financial resource center to watch key segments of this webinar at your convenience. Thanks again for joining us, and have a great day.